I know for a fact there's someone watching this video that has blown their account within the past 2 weeks. Now, it's not a surprise. We've had a lot of changes within the markets very recently. So we've gone from a very bearish dollar very quickly to a bullish dollar. We've had tensions in the Middle East, which have caused whipsaws within the commodities markets and the risk on, risk off assets. We have also seen the yen be very volatile, with changes from the Bank of Japan, from hawkish to dovish to dovish to hawkish. So it's been a very difficult period to trade recently. So what I want to do is explain to you how you can avoid these types of things and how you can adapt to the market conditions. So if we very quickly go over here and we look at the VIX. So this is the Volatility Index, and what this essentially does is measures the risk appetite that investors want to take in the market. So the higher the VIX is, the less risk that they are looking for. So when we see spikes like this, we often see gold spike, we can see the yen and the Swiss go up, and we can see things like the euro, the pound go to the downside. And it's the opposite when we're low on the VIX. So a low VIX volatility, or sorry, a low volatility index indicates a more risk on market. So what you will typically find is when we have whipsaws, like we've seen a huge whip up here, and this is when we saw the unwinding of carry trades on the yen. Since then, we've been up, we've been down, we've been up. Bearing in mind, this is the daily time frame, so this will reflect a lot heavier on smaller time frames. It can be very difficult to trade, and you will find that strategies that work on high VIXs don't work when the VIX is low, and vice versa. Now, this isn't always the case, but 9 times out of 10, strategies don't work in both conditions because they rely on a specific thing, whether it's, again, a high VIX or a low VIX. So to avoid this, there's 2 things you can do. So you can either have just one strategy that you trade non-stop the same way day in, day out, or week after week, and you never change it, and you just accept that you may have losing streaks when we do see a difference in the VIX, or you can have 2 strategies. So what I do is I have 2 strategies. I don't like to just rely on one because, like I said, sometimes what works on the VIX might not work tomorrow if we see a huge risk off market. If I'm on some risk on assets on swing trades, they'll all get stopped out or break even or whatever. So I would rather be able to diversify with different strategies across different assets. And this is just what works for me. So for example, there's a swing trade here on the dollar Swiss that looks really good. So we've got this sort of resistance through here looking for a break and a retest. However, if we zoom out a little bit and we pay attention to what's going on, we've got a very strong dollar at the moment. We've just had a huge NFP with a 100K overshot of what the forecast was in the previous. So we've got that. We've also got a strengthening labor market. We've got less unemployment. So the dollar's looking pretty good after a really bearish move to the downside, you can see on here. However, what we also have is the Swiss that's doing very well for itself. The Swiss has held up against the dollar quite well during this period. And we've also got to take into account at the moment of making this video, we've got tensions in the Middle East. So if we see an escalation there, what do we often see during times of war? Well, we see risk off markets. But because it's war driven, we will see the dollar do pretty well as well. So what I don't want to do is get into a swing trade, something escalate in the Middle East, and I'm stuck in a trade with 2 very strong currencies. So moving on, I would rather, at the moment when we've got some market uncertainty and we've got a little bit of a mix between risk on and risk off, I'm not seeing a very clear defined risk appetite from investors at the moment. I'm happy to just go in for my day trades. For this specific strategy, when I'm trading for a risk off market or market uncertainty, I don't want to go for huge swing trades, and I don't want to go for 1 to 5, 1 to 10 day trades. I'm happy to go for a 1 to 1 or a 1 to 1.5, take my profits and get out of the market. So you can see here on gold, this is a great example. I'm bullish on gold overall because we've got a lot of factors that are working in gold's favor. However, at the moment, it's stuck in a bit of a range. So what I'm doing is getting in and getting out. I'm not looking to get into a swing trade here because of A, we've got the range, and B, we've got very strong US data. So I don't want to hold the gold in case we do see that dip, that sort of ripple effect from the dollar go into gold. So I'm happy to get in, get out. As I said, you can see here we've just got a 1 to 1 roughly, and then here we've got a 1 to 1.2. So they're not huge trades, but this is great. This is almost a 3% gain across 2 very short-term trades. These lasted a couple of hours each. and that's it, we're out. So I would rather have these smaller positions, just sort of day trading or scalping these currencies rather than trying to hold them over the long term. So you can see on this graph here, this is the sort of typical or a very sort of basic blueprint to currencies, or how I approach currencies. First of all, we've got the central bank. So we've got, what is the central bank doing? Are they looking to hike rates? Are they neutral, so wanting to hold rates? Are they dovish, so they're wanting to cut rates? What is the central bank's policy? Next, we've got, the GDP. How's the economy looking overall? Is it growing? Is it contracting? Very important to pay attention to. We've got sentiment, so we've got COT data, we've got risk sentiment, we've got the retail sentiment as well. So it's good to know how is everyone positioned in the markets. We've also got unemployment, we've got inflation. Obviously, there's other factors as well, but as I said, this is just a very basic blueprint here just to show you the example. So if we go over here and look at what the central banks are doing, well, we've got the ECB, we've got the BOC, we've got the SMB, we've got the RBNZ, we've got the BOE, and we've got the Fed, all cutting rates. So there's not much of a central bank divergence. Obviously, we do have the RBA, so the Reserve Bank of Australia. We've also got the Bank of Japan that are holding, so we could get some longer term positions based off central bank divergence. But obviously, if all major central banks, or the main ones that I personally trade, are all cutting, then it makes it a little bit more difficult to try and find that divergence. Obviously, then we can look at how aggressive they are and how long the cuts are going to last and things. But overall, it's not ideal. So at the moment, as I said, I'm happy to just be in and out of the markets using day trades. But yeah, it's very simple. So in terms of the dollar right now, we've had a very bearish dollar again, as we saw an unwinding of carry trades. We also saw sort of a general risk off market, and because it wasn't necessarily war driven at this point, we did see the dollar start to decline. This was also a lot of pricing in of rate cuts during this period. And then once we got the 50 basis point cuts, we actually didn't see much of a reaction because it was already priced in. We've sort of just been ranging since then. So since that point, the data for the US dollar has either been neutral or positive. So as I said earlier, we've had a very good NFP and a very good unemployment reading. So it looks like the US labor market is doing a little bit better at the moment. We also can then use that as sort of a signal to say, okay, well, the Fed's previous 50 basis point cuts that they did last month likely won't happen again because their goal of that seems to be taking effect now. So we can now start saying, okay, well, maybe it's going to be 25 basis point cuts or even a possible hold. Now, a hold is more unlikely, but that rate cut decrease is a good factor. So it's just things like this you need to pay attention to, having an understanding of what's going on in the market, why are they moving, and if you're not totally sure, then there's other approaches you can take. So when we get more clear markets, I'm happy to go back to my swing strategy and then start trading as I normally would. But for now, my day trading strategy is providing the results at the moment. So I hope this video has been of some help to someone out there. Again, just take trading slowly. It's not an easy job to do. Trying to build your own forecasts for all these types of things. There's a lot of factors and a lot of things that relate to each other and correlate. And yeah, there's a lot going on. So it's completely understandable that people get confused and they get whipped out of moves quite quickly. So yeah, take your time, test different strategies and things, and pay attention to what the VIX is doing. Pay attention mainly to sentiment, because yes, obviously, economics drive the markets, but also what's driving the actual price movements is what are investors doing, how much money is going into the markets and driving it a specific way because they view the economics in a certain way, if that makes sense. So guys, like and subscribe, it means a lot to me.